Welcome to TheoTrade. This is Don Kaufman. It's March 23rd, 2019, and you are watching the TheoTrade Weekend Update. So on this weekend's update, I want to spend quite a bit of time discussing some of the opportunities moving forward. Before we get there, we got to rehash a little bit of this past week of trade. We obviously have to discuss the Fed because I think that's going to impact, again, a lot of what I see as the opportunities effectively moving forward. With that, let's get right to it. Let's start with a quick discussion, of course, of the Fed. Well, this week we had Jerome Double Down Dove Powell come out and, do just that, double down on the dovish take, of course, of the FOMC moving forward. So one of the things I want to bring you into some perspective of again, strictly my opinion in what I see in terms of the Fed, I'll just lay it on the line over here. They completely disarmed themselves. Why? Well, first of all, they said for the rest and the remainder of 2019, they're not really going to do any rate increases. All right, that's number one. Number two, when I say double down dove, well, the second portion of that is they're going to stop the runoff of the balance sheet right around $4 trillion. That's it. Okay. The problem is that is it. We're done. We're done. What are they going to do for the rest of 2019? There's actually a decent probability now of even a rate cut coming into late 2019. Not sure if everybody was aware of that, but the probabilities of a rate cut have risen substantially. Anyway, the Fed comes out and immediately the marketplace, they love it. They love it. Come on, we're not going to raise interest rates. We're all going to sing Kumbaya, get together at a campfire. We can all buy houses for the rest of our lives at low rates. Credit card debt is going to be low. Then all of a sudden the market actually conceptualizes this and says, wait a second, the Fed, now they're caught with their pants down. Why? You know what the monetary policy is moving forward. Yes? Okay. The other aspect you have to think about, okay, what caused the Fed to do a complete, not just 180, but we're 90 days removed from the Fed raising interest rates. The last raise was in December, but Jerome Powell there, he even had a speech in early January of 2019, that effectively said they're still going to be on the path to possibly raising rates. Here we are, okay, less than 90 days later than that, and not only have they done a 180, okay, but again, they're cutting off the, again, tapering of the balance sheet, which is taking it multiple steps further. So as a trader, how do you want to interpret this? And again, here's kind of the opinion piece and strictly how I am interpreting it, okay? Either number one, and again, these are the two, I guess, decisions that I've made as a trader. Either number one, the Fed has seen something so horrific economically. They see China slowing down. They see like Germany is in a recession now. They haven't officially said that, but Italy's in a recession. That is official. But Europe is slowing down, very likely in a recession. Okay, if Europe catches a cold, if China catches a cold, it's going to spread to the U.S. Either number one, they see that, or number two, the Fed just has absolutely unequivocally no clue of what's going on. You pick. And you think about that. There's really no other relative alternatives. Some people will probably think, well, there's an election coming out here in 2020. Maybe that's why they're backing down the rates. All right, yeah, I can throw that conspiracy theory, out there as well. Nevertheless, it's one of two things, and I actually believe it's the fact that they're looking at data. And I really do think Jerome Powell is extraordinarily data dependent, and some of the data they've gotten in the last 90 days is literally that horrific. So they've completely changed course. It took the market about 24 hours to realize this. So again, the Fed comes out on Wednesday. Right, markets take off a bit to the upside. Coming into Thursday, we explode higher. Everybody that's in a bearish position at once, there's upheaval over there. Me, I like it. I actually put on some bearish positions, some more duration bearish positions on Thursday. And on Friday, what do we get? Well, for those of you that are bearish, absolute bliss to the downside. S&P is closing down by the tune of almost 2%. See the Russell? The Russell got absolutely rocked by the tune of about 3.6%. Just on Friday alone. Nevertheless, again, you got to think of this dovish kind of scenario as the Fed's now exposed. You know what the game plan is. What are they going to do for 2019? Nothing. So the market and all of the traders are kind of left to their own devices. And at this point, you're sitting there kind of contemplating like, that's a good point. The data must really suck for them to have done this kind of 180. Now what do? We sit here as traders and we wait for horrific data to roll in? Or do we get ahead of it and start whacking the markets left and right? And that's where I believe that, again, being bearish happens to be the place to be, not only from a stance of wanting to be bearish, but really from a stance of it's where the most viable risk reward is going to be. And I'm going to show you that here in a couple of positions we're going to look at specifically. As I said, I'm going to spend a lot of this weekend update, opportunity. A couple other things I want to point out before jumping into some of those opportunities when we take you to the chart, some of the option chains. Okay, let's talk briefly about the bond market. Obviously, this is related to the Fed. The bonds, though, specifically the bonds and the bond futures, that is the ZB. Those things are trading at like what I term Armageddon levels. The bonds have rallied through the roof. Most people now are aware of what the 3-month and the 10-year inversion of the yield curve. Enough said on that front. I've spent a lot of time in the TheoTrade chat room discussing the inversion of the yield curve. But hey, the bottom line is, it's a recession indicator. As I said, you're going to sit and all of our worst fears are going to come to fruition this summer as we wait for more data, more earnings to come out. We're likely going to be into an earnings recession in a lot of these stocks. Okay, are the stocks, just going to go out there like an Apple? They're going to just do more stock buybacks? Are you going to believe that stock buybacks are going to continue if we're going into an earnings recession? Gotta love that one. So the bonds, right? So come back to the bonds. The bonds are trading in such an elevated stance that you have to be, again, kind of nervous moving forward. One of the things I kind of brought to your attention, not only last weekend, last week, the week before that, is one of two things is completely wrong here. Okay, the bonds have remained elevated for a substantial period of time. Okay, and again, we have the bonds that have remained elevated, but the S&Ps continue to rally. Equity markets are rallying. One of those is wrong. Well, we might be finding out here as of Friday which one is wrong. The bonds, they just continue to go higher. Right now, the equity markets, again, this coming week of trade, it's going to be Mr. Toad's wild ride inside of the marketplace. Now, specifically, what I've been also talking about extensively, the XLF, the financials. The financials are really what rocked the S&Ps. I mean, the XLF was down this week, just to give you kind of a perspective of how substantial the XLF and the influence of the financials happen to be. The XLF came into this week, was up about 13%, just shy of 13% on a year-to-date basis. It ended the week only up 5% on a year-to-date basis. So the financials got absolutely rocked, and you guys will know if you've listened to anything that I've talked about in the last couple of weeks, couple of months. It's the financials that are in the driver's seat for the S&Ps. So this actually, and therein lies, I think, a great opportunity. The financials already got crushed, right? We're bearish in the financials. We've had bearish positions on. It paid us very, very nicely this past week. But moving forward, if the financials remain under pressure, the other sectors are going to start to fall. And that's exactly where we're going to look at for some of these opportunities. With that, let's get to it. Let's show you a couple of the opportunities. Let's also talk a little bit about some of the expected moves and get into some of the finite details of what we can expect moving forward. To the charts and trades we go. Let's start here on the SPX, of course, because we're going to be looking at the expected move. And with that, I just want to bring you into kind of scope of the expansion, if you will, of the expected move. For those of you that are a little bit newer and maybe you're not necessarily in tune with the idea of expected move is how the option market delineates risk moving forward. So here we have the week at large. This, of course, is last week. This center line right there. That's where we actually started the week. Of course, we, throughout the course of the week, rallied to the upside, actually hit literally the edge of the expected move. In fact, that is worth kind of zooming in on for just a moment to see we're on it. We actually stopped smack on the edge of the expected move. For those of you doing expected move butterflies, well, you had to bail on Thursday, or that trade was gone, nevertheless, right to the upper edge of the expected move. The point that I want to make, though, about the expected move specifically from last week, is the expected move was right around $33. In fact, if you take a look quickly at the, here's the Analyze tab. I'm just going to take you into what we term Think Back. What is Think Back? This is end of day data. It's just from last weekend. And I wanted to show you, we were trading at about a 10% implied volatility, about 10.5%, and right around a 33, again, a $33 expected move. So how does that compare? And I'm going to zoom out here for just a second. How does that compare to what we can expect this coming week? Now, this coming week, you can see, again, just in quick visual over here, there's one expected move. There's the next expected move. Yeah, it expanded substantially. So remember, about a 10.5% implied volatility. Now, what are we sitting with? Oh, almost a 17% implied volatility and a $52 expected move. What does it tell you? Well, again, stands in kind of stark contrast to the week before. It says, put your helmet on and get ready. With that, we have, again, a $52 expected move. So just that, you have the S&Ps kind of closing, and specifically the SPX closing right on 2,800 on the money. And you got to look for, a minimum of about a $52 move in either direction. Here's another week where I don't want to sell options. Why? Because we might just be on the verge of an expansion of implied volatility. In fact, with the expansion of implied volatility, I think the next nice thing we want to kind of delineate to you, a lot of people look at the VIX, yada, yada, yada. I would much rather take a look over here at the VVIX, the volatility of the volatility index, and wake up, because the volatility has woken up. This is the professional world all at once, pretty much screaming and crying out, we need to buy volatility, and they're buying volatility in the VIX. Here's the thing, though, about buying volatility. I was talking about opportunities moving forward. I'm going to go through a bunch of different stocks here momentarily on those opportunities. One of the opportunities that isn't there, you can't buy volatility. Either you were in VIX trades or you're not, period. Now, when I say in VIX trades or not, I'm in them. I've been actually loading up on VIX volatility spreads and kind of variants of VIX volatility spreads. You can see I've got April trades on in here. I've actually got May trades on. It's a party. I'm set. But on that front, I'm sorry. Chicken is done. Either you were in volatility positions, or you missed it. And that's the way you have to trade with volatility. Look, the VIX spiked by 20% just, in one trading session, not to mention the VVIX, which is the volatility of the volatility index, was also up about 17%. So as I said, that chicken is done. Next thing I want to point out, skew. For those of you that have never looked at skew, it's a little weird to look at. First of all, you have to bring it up on a line chart. Skew is only calculated at the end of the day. One of the things that really stands out to me, and again, this is moving forward. I'm going to bring up a 10-year weekly of skew. Look how low the skew is. For those of you that have just no clue what skew is, that is fine. It's the out-of-the-money puts in the SPX versus the out-of-the-money calls in the SPX. The way to kind of think of skew is, let's go to the SPX. I think the best ways to kind of delineate this, skew is measured right at the 30-day marker. 30-day marker, I'm going to open up all options in the chain and cruise over here to what's termed implied vol, right? So what skew is measuring is it's measuring these out-of-the-money puts, those out-of-the-money puts, and the differential of the out-of-the-money puts versus, for example, the out-of-the-money calls. And in this particular case, what we learned about looking at skew, and again, I just brought that symbol up, right? We looked at skew, it's 117. Some of the lowest, that's one of the lowest readings ever, right? And again, I'll pull it up over here in the chart. It's one of the lowest readings ever recorded. Yeah, there's a couple little instances here, but I will denote the skew being extraordinarily low before we went into wild bouts of volatility. Why would the skew be inherently low before wild bouts of volatility? Yeah, it's a good question. It's a really good question. I don't necessarily have an answer. All I can kind of surmise from this is that you get some traders that are volatility starved, that are actually the first sign of a down move. I believe they're probably selling puts. And you're like, what? Who sells a put when the market's tanking? A lot of professional traders. They sell puts when the market's tanking, and then they actually hedge dynamically with S&P futures. So it's a trade that's going on. It's relative right now, but the skew is really, really low. And got to look at this as almost like a little bit of a contrarian All right, that could be a warning shot across the bow because the last time the skew was this low, we were rocking in terms of volatility. Speaking of volatility, let's go to the S&P futures themselves. All right, why am I going to the S&P futures? Because I got to talk to you a little bit about gravity points here. Gravity points, that is, that's trademarked. It belongs to TheoTrade. Now, gravity points is what I call very specific levels inside of the S&P futures. Now, if you take a look at some of the gravity points, right over here is 28.42. Here we have 28.11. If we're going to start getting a lot more volatile, we're going to be pinging back and forth between gravity points. But quite frankly, we lose 28.11. I don't have anything. Okay, anything. And again, I have to zoom out for this one because behold, I got nothing till we get all the way down to 27.31. So just be aware of that. And the reason I'm saying being aware of it, am I warning you? Are we going to 27.31? A little bit. Yeah, I am. And you know why I'm saying that? Because I got to tell you, when you start getting volatile and you start pinging back and forth between gravity points, let me just show you something. Okay, this is a 180-day, 4-hour chart. You realize there's no in between. There's no stopping place, okay, between 28.11 and 27.31. Okay, effectively what I'm saying is if we slip below like 2800, put your helmet on because we're going all the way down to 27.31, and that's where things can get really, really wild. But again, to show you how these gravity points are kind of not only holding water, but here's actually a move, a very rapid move from the last time we actually moved from 28.11, 27.31. Ripped back off of that back to the upside, but this is some fierce sell side that we saw. There's no question about it inside of the S&Ps, and again, we very well may be looking at some follow through. Again, the next stopping point would be 27.31 in terms of the S&Ps. Now, with that, we talked a little bit about the SPX. We looked a little bit about the volatility. We basically said that ship has kind of sailed if you're trying to buy volatility. Next thing you got to bring up is the bonds. The bonds, as I said, are trading Armageddon. There's not that much else I want to say about the bonds other than look at the 10-year. You got to look at the 10-year. It's the TNX. Okay. I mean, it just got slaughtered this week. It was almost like the Fed sought out to try to invert the yield curve. Why? I don't really have any reasoning for that, but knowing they were going to actually, stop the reduction of the balance sheet, I just basically forced the yield curve to invert. And again, by the way, the yield curve inverting, yeah, it's a sign of recession and so forth. But signs like that were kind of, and it's an indicator that's had a 100% track record. It doesn't mean as much to me. Okay. And the reason it doesn't mean that much is because for the most part, we're, a Fed-driven world now. It's vastly different than any other recession. Okay. Because I think people always try to draw comparisons from previous recessions because that's all you got to go on, right? The yield curve inverted, all of a sudden the clock goes on and 300 days later, poof, we're in a recession. I don't necessarily think that's going to be the case over here. So the yield curve inverts, and for all we know, the rest of the world is already in a recession. But on this front, listen, the Fed can still do quite a bit, but that would be, again, well beyond probably 2019. Nevertheless, it really did feel like they forced the hand of the yield curve to invert in this particular circumstance, but dropping down to 2.4% on the 10-year is fairly shocking. And the reason I say it's shocking, you got to start pulling up some pretty substantial time frames to see rates this low. Again, we've done nothing in 2018 but talk about the raising of rates. Well, that's all been undone basically in a handful of trading sessions. So something to think about moving forward. As I said, when it came to the bond markets, right? I mean, we actually did a comparison chart of this, right? Either the bonds were rallying, okay, and the equities are rallying. So one of them is wrong, right? And that's exactly the premise we took. One of them is wrong. Well, in this particular case, we believe the equity market is wrong. The equity market's likely to come off, and traders, they saw this coming. By the way, one other area to add to that. If you take a look at the XLU, this is a position I've talked about extensively lately. The XLU, this is what? It's the utilities. Like the utilities are still up, almost 13% on the year. When we looked at the utilities, and we looked at this just a week ago, we said What do the utilities see that the marketplace doesn't? And apparently, we now know the answer. I mean, this is capital that's been flowing into the utilities nonstop. This is one of the most linear moves that you've ever seen, okay? And yet, if you take a look at the spiders, okay, the spiders also, this is a year to date, okay, rallying to the upside. Well, guess what? The spiders, the S&Ps, they blinked first, and now they're headed to the downside. So there is a reason, apparently, that money is flowing into the utilities, and that's because there's a fear trade out there. Okay. Now, let's get to some of the opportunities that we see kind of moving forward. One of the things I want to bring to you on the opportunities moving forward is, well, stuff that's not necessarily there anymore. If we take a look at the financials, here's the financials. As I said, they got decimated this week. Okay, we saw the reversal on Tuesday. We warned of the reversal early in the week coming up to the 27 level for those of you that tuned into the evening video. And please, check out the Monday night video from this week. Check out the Wednesday video. In the Wednesday video, we just outright called like we're hugely bearish in the market and specifically in the financials for the remainder of the week. Nevertheless, we got that market again moving for us. And here's the financials up almost 13% year to date, ending the week, as I said, up only about 5% on the year. Again, only 5% now on the year. That is a significant slide. As long as these financials are under duress, so are the S&Ps. Remember that moving forward. I don't want to hear like, but tech. Well, here's the thing, okay? But tech? No, tech's the opportunity right now. Okay, not the opportunity to be long, it's the opportunity to be short. Tech's not going to save anybody or anything. Let me start with Microsoft. Okay, Microsoft did get whacked back over here, but it's still a stone's throw off its all-time high. If you're looking for opportunity, and again, this is what you should be thinking about right now, is moving forward. Opportunity. Okay, risk reward in here doesn't get much better than this. How much more upside potential is there versus downside risk? That's all you have to ask yourself. If you want to be in this for, well, duration, use a duration. It's an in-the-money put. It's a synthetic short, okay? It's a synthetic short position by buying a deep in-the-money put. If you're looking for a little bit more for the short term, just use an in-out spread. Get bearish, okay? Get back and watch it fly. If Microsoft is too rich for your blood, okay? Let's go actually look over at none other than Intel, okay? Intel, very similar situation. Now, Intel, okay, has had a magnificent rally, and if you take a look at the year-to-date percentage, it's not too far from what we're seeing in Microsoft. But again, from a risk-reward standpoint, yes, it got whacked and whacked hard on Friday. But again, we're still a stone's throw off. It's some of its recent highs in here. Moving right along, as I said, there are a lot of opportunities. Moving right along, here's another interesting one. XLY. Why am I looking at XLY? XLY is, first of all, it's consumer discretionary. But this particular ETF is heavily influenced, okay, from none other than Amazon. Amazon is a huge weighting. What I found interesting inside of this was that the XLY only down about 2%, where Amazon got whacked by 3%. This is kind of a sharp little way to get short a little bit of Amazon along with consumer discretionary. But take a look at that run. And again, you're looking for opportunity right now. And I'm going to tell you again, the opportunity, okay, for me, it's all about risk reward. Like if you're going to say like, but this thing could continue, could rally back up. Oh, let's get crazy. What? Oh, it can go all the way back up to 120 all-time high. Do it to me. Okay. I'll take it because the downside potential over here is absolutely massive. You're looking at consumer discretionary. I don't care what you might think about Amazon. Okay. I want you to think about what the Fed just did. And what the Fed just did is just screamed, things are not going well. The risk reward in a trade like this could be absolutely phenomenal. And that's why I want to be short right now. Duration in the money put. Or again, if you think it's coming more in the short term, you could use an in-out spread. But get aggressive, okay? And when I say get aggressive, don't necessarily allocate heavily. You got to get aggressive. You got to execute in a position like this. Now, I'm going to actually switch my stance a little bit, okay? And we're actually going to look at stuff like CSX, okay? You would think that CSX would reinvent the entire world, but turns out it's just a train. CSX has kind of leveled out lately. There are earnings coming up relatively soon inside CSX. Nevertheless, okay, very similar stance. I'm using a duration in the money put. Again, I am carrying positions. I'm carrying positions in the Microsoft. I'm carrying positions in the XLY. I'm carrying positions, obviously, here in CSX. Okay, so all of these, I've established some positions. CSX, has been an amazing run to the downside in the last time the market saw a bout of volatility, but right now has been bid up again, has been relatively unimpeded by yesterday's sell-side activity. Last but not least on this front, let's find one that's pretty much at its all-time high, none other than Starbucks. Okay, now Starbucks, okay, they might use Starbucks as a defensive stock for a period of time, but sooner or later, if the S&Ps are going to head to the downside, they're going to hit them all. And when I say they're going to hit them all, like, listen, this has been relatively defensive. Starbucks yesterday only closed down 0.4%. And again, I want to highlight this because this is the stuff you gotta get on, right? It only closed down 0.4% with the S&Ps down roughly 2%. What gives, right? What gives? Well, I'm going to tell you what gives. Eventually, they hit them all. This is the S&P 100. We see some more sell-side activity. They're going to crack Starbucks in half, all right? Look for it. I don't mean they're actually going to knock the stock in half, okay? But they're going to hit this stock and hit it hard because, again, anything that's been outperforming the markets, okay, in the midst of some sell-side activity, sooner or later, they'll turn that algorithm gun right towards Starbucks and hit that as well. Again, I am sustaining a multitude of positions inside of Starbucks as well. Listen, there's a lot of short opportunities right now. I find it incredibly difficult to want to get long. That's just simply my take. I mean, do I want to get long after this? No. No part of me wants to get long. Why? From a risk-reward standpoint, all right? You have a marketplace, okay, that's been creeping up day in and day out. The damage that was done on Friday, it's negligible, okay? We haven't even scraped the surface, right? And again, could we even bid back to all-time highs in the marketplace? Absolutely, unequivocally, yes. Okay, like I'm not at all, okay, objecting to the idea that we can even hit 300 inside of the spiders. What I am looking at, though, again, is that downside potential. Even if the downside potential maybe takes us back to 240 inside of the spiders, look at the risk reward that affords you. That's what this business is about, okay? Oh, you sit there for the last 2 to 3 months and we're just grinding higher and you're wondering every single day, why am I short? Well, now you know. You get one down day and you're like, I'm back, baby. It's a lot to think about in this weekend's update. With that, one final announcement before we let you go. Last but definitely not least, TheoTrade.com/live. Again, that's TheoTrade.com/live. That is the link to our live event coming right here in Scottsdale, Arizona. When I say live, yeah, you're coming to Scottsdale, Arizona. It's going to be starting the evening of May 30th through Saturday, June 1st. It's really 2.5 absolutely packed days and packed sessions. We've actually got everybody from myself, Jeff Bierman, Corey Rosenblum, Tony Rago, Brandon Chapman, Slim Miller's coming out, Matt Williamson. The entire TheoTrade crew will be out at this, of course, live event. It's $997. Why am I bringing it up right now? Again, TheoTrade.com/live, because our early bird pricing, that $997, it ends March 31st. Our room block is also almost completely filled at this hotel. You want to go to this event, you need to get yourself enrolled before the end of March. Again, the early bird pricing ends March 31st. TheoTrade.com/live. Thanks everybody for joining us here for this weekend's update. Bye-bye.